I'm going to talk to you about how Washington is messing up your lives a little bit. Among those topics, we'll start off with, because of the issue that just came up, that Scott just mentioned on LO-Comp. We'll start with LO-Comp. And again, these topics are just things that I think there's some developments here in the enforcement side at the CFPB, and topics that are probably important to you as originators. I assume that most people in the audience are originating. Is that right? Is this mostly a production group? Yeah. So I'll try to focus on issues that I think are probably important to you, and try not to get buried down into the details of arcane matters. The CFPB is focused on, by its own admission, is focused on a few different areas for 2016. They're focused on LO-Comp, so it's a good topic for you guys to be talking about. Focused on Section 8, which is, I think, what is a topic of interest these days as well for originators. TRID compliance, which I know you guys live and breathe TRID every day. I know that it can be complicated, but I don't want to dive too deeply into that today. We can talk about it if you want, but I don't want to dive too deeply because it'll put you to sleep. Fortunately, I have my morning vodka here that will hopefully help out. They're also focusing on compliance with the ability to repay, which again, I don't think is something we want to delve too deeply in here, but it is a topic the CFPB cares about and is focusing on during their exams. And so if you want to chat about things like non-QM and so forth, happy to do that. They're also focusing on fair lending. We may be able to touch briefly on that. We'll run out of time, I'm sure, depending on questions. And then UDAP, which is their catch-all of, if I don't like something and I can't get you on the law, I'll get you on some sort of abstract concepts that it's unfair and deceptive. So we'll talk about that if we have time. So the LO-Comp rule, let's start there. The LO-Comp rule hasn't actually changed since January of 2014. There was the first iteration in 2011 where it first came into effect. And then in 2014, there were some tweaks, but the rules haven't exactly changed. It's just that there are lots of questions and novel ways that originators have tried to figure out ways to deal with LO-Comp. And then we have the regulator, CFPB, at the top that is focused on enforcement and looking at the LO-Comp issues in their exams and in enforcement actions. The three basic principles of LO-Comp remains the same right from the beginning, back when it was with the Federal Reserve Board. The basic rules are they don't want you to steer to your own advantage. And these are just concepts. It's not specifically the language of the rule. They don't want you to steer to your advantage where you disadvantage the consumer and you get the benefit as an originator. That's one of the primary principles. They also don't want you getting paid on two different sides of a transaction. So they talk about a consumer can pay a loan originator, or somebody else in the world can pay a loan originator, but you can't get paid on both sides because consumers never could figure that out. They never understood that. Brokers primarily were getting paid both by the consumer and then also by some lender. So it mainly came up in the broker context, but that's an area that they focused on. And then the basic idea that you live with every day is you can't get paid based on the terms of a transaction, and you can't get paid based on a proxy for a term of a transaction, which is a concept that was pretty vague to begin with, but later on they clarified a little bit. And in the 2014 rule, they expanded the definition of loan originator itself to be a lot of people that weren't previously defined as loan originators. So sometimes loan originator assistants come up, sometimes business development people come up as loan originators potentially. And perhaps even, although a lot of them don't know this, but perhaps even the lead generators are sometimes deemed to be loan originators under the rules. And that's an area that is still being explored. The CFPB hasn't had a lot of action there, but they're looking into those issues. And so those guys, I think, are at risk. But because you pay them, you also potentially get swept into that morass that CFPB is looking into there. One of the big issues on LO Comp is that there is personal liability for LO Comp violations. So if there's an LO Comp violation, there is exposure for the company, and that's the typical truth in lending exposure. So they got 3 times finance charges, and they have $4,000 per violation as a penalty under the statute. They have actual damages to the extent that somebody can claim that there are actual damages there. So there's pretty significant liabilities for the company. But in addition, the individual loan originators are liable for 3 times the amount received. So if you think about that, how many people in here made more than $100,000 last year? It's just a good amount, right? It means it's a good company to work for, right? Multiply that by 3, whatever you made, and that's how much your LO Comp violations would have cost you last year if you did in fact have violations. So it's not an area where you want to be particularly aggressive. The rules are largely unclear. The CFPB is very aggressive, and the penalties are pretty dramatic if the CFPB second guesses you. Now you could always go to court and you could make the CFPB prove its case and make them prove that there was an actual LO Comp violation, but going to court is very expensive, and meanwhile they can tell you to put the money in escrow. They can tell you to, they can make your life pretty miserable. So it's an area that you really don't want to be really aggressive on, because the way it plays out is if you have an LO Comp violation, you probably have it for every loan that you do, because the quirky little loan, the one-off program that you do that turn out to be a violation probably means that all the other transactions were the reverse side of that LO Comp violation, and so there's violations for both of those types of transactions. So that area, I think, is an area that you probably have dear to heart, and also that CFPB is focusing on pretty heavily, and one that the penalties can be big. Let's talk a little bit about what is a term. We said you can't pay based on terms, and you can't pay based on proxies. So you probably know this, but let's just think about it just a little bit. So you can't pay based on a term. What is a term? A term is a right or an obligation of the borrower. So things like the amount of fees that they're going to pay, the things like loan to value, the way the products are set up, your different products. And then the CFPB said, well, terms also include a bunch of terms together. So for example, a loan product or a loan type, whether a loan is an FHA, whether a loan is a jumbo, whether a loan is conventional, whether a loan is an ARM or a 30-year fixed, all those are a bag of terms, says the CFPB. And so you can't pay differently based on those loan products or loan types, because you'd be paying based on the term. So that's the first concept. The second concept is you can't pay based on a proxy for a term. And a proxy for a term, that was very complicated early on. Nobody knew what it meant. Now we have a vague understanding of what it means. And the word proxy is now defined as if some factor out there, some factor that that is involved in the loan differs with a term. So let's say, for example, you have FHA loans and you have conventional loans, and the FHA loans, the interest rate, which is definitely a term, is higher, let's say. If there is a factor that varies with the term, and also the loan officer, the loan originator, has the ability to steer to one type of product or a difference from FHA to conventional or vice versa, then that's considered a proxy. Now, I mentioned FHA versus conventional. They say that's a bag of terms anyway. But even if they couldn't get you there, if they lost in court there, they would say, well, it's still a proxy because you have the ability to influence whether a person gets an FHA or a conventional loan. So that's an area where it's just not the place where you want to be spending your time probably. The compensation really can be anything. So if they give you a pixie stick, that's considered compensation. And so, you know, it's normally, of course, it's commissions, normally it's bonuses, it's sometimes there are trips and drawings, all of that is considered compensation. So if you get compensation based on these different types of terms or proxies, then that would be considered to be a violation. There have been some pretty big, really settlements, they're all settlements. There have been some pretty big settlements in the LO comp area. And you may know some of these may have gone under the radar. But the first one, back in 2014, I think it was, Castle & Cook is the name of the company. But Castle & Cook was paying bonuses that the CFPB alleges, all of this is just allegations, the CFPB alleges the bonuses were based on different interest rates. All of this is the old rule, by the way. They haven't had any enforcement yet of post-2014 violations. It's just too new. They go in and they investigate, they examine for a couple of years back. So all of this is under the old rule beginning in 2011. But they said there were bonuses that were set up that encouraged people to charge higher interest rates and paid bonuses differently based on higher interest rates. And so Castle & Cook at first resisted, and ultimately the company and two of its officers settled, and they settled for $13 million, which is a significant sum of money for any company. Castle & Cook's pretty decent size, but it's a pretty big amount of money, of course. Another case in 2014 was Franklin Loan Corp. There were allegations there that they paid quarterly bonuses, again, based on interest rates. The penalty there was only $730,000 compared with $13 million. That sounds pretty good, but it still would affect my bottom line. It's a pretty incredible amount of money to talk about with it, that company being a pretty small company. But not to be outdone, the CFPB always tries to make things better. So in 2015, you may have heard of this one too, RPM settled, and RPM settled for $20 million, including $18 million by the company and a couple of million tossed in by the owner and CEO because of these violations. Again, these are pre-2014, so on these loans, there was no specific liability for the individuals, the loan originators themselves. But I would guess that the CFPB will be trying to make an example of some others in the near future. The allegations in RPM were that they had set up point banks. So they were putting money into an account for a loan originator specifically, and then allowing that originator to use that money for various things in the business. So they weren't actually paying money directly to the loan originator, but they were setting aside this account that a loan originator could use for various things. And they call it a point bank loosely. Nobody quite knows what a point bank means because it means so many things. But the CFPB has said several times that they've never seen a point bank that works. People make arguments as to this is okay, that's not okay, and so on. But they say, you know, if it's a point bank, whatever that means, it doesn't work. But they're the ones who impose the penalties. There was another case, again, sort of flew under the radar because there's only $228,000 in penalties. But Guarantee Mortgage Corporation, there are a lot of guarantees out there. So this is a company that is, it was a lender and it wasn't Guarantee Bank and so on. Guarantee Mortgage Corporation, and they had situations where the loan officers, again, were being paid indirectly because the loan officers had companies. So the LO would get paid his own compensation, commission, et cetera, for loans he was doing, but then he also had some company out there that provided services theoretically to the company, and there were payments being made to those LLCs is what they were, and they called that indirect compensation, and it was in this case based on profits, which is impermissible under the LOCOMP rule. And so they paid $228,000, but they were going out of business, so that was as much as they could afford, and they didn't impose a greater penalty. Our firm handled that case, actually. And so I thought that was a pretty good difference between 228 and 20 million. But at the same time, the company was already going out of business, so it was closing the door as we paid the check. So let me stop there. Actually, I've talked about LOCOMP to some degree. We can go much deeper if you want to. But any questions LOCOMP related at the moment? Yeah, I have as much as you want. I mean, I'm trying to talk to issues that are dear to you. So, and I only have an hour or so, but and I'm happy to stay afterwards too, and chat. But you know, the company asked me to come do this so that you guys can talk and feel free to, and I'm happy to do that. Yes.
What's the prevalence of the Consumer Financial Protection Bureau's take on our people to be changed and/or reformed every 3 months?
Yeah. So there's no specific time period that they'll tell you that you can change comp plans. What they'll tell you is the rule is pretty straightforward. The rule is you can't pay based on terms or proxies. And I'm oversimplifying, but can't pay based on terms or proxies. That's the rule. And so what they'll tell you is you can't pay based on terms or proxies today or in the future. And in addition, you can't pay in the future based on prior terms or proxies. Does that make sense? And so if you are changing in order to make up for that past terms or proxy payments, either because you paid too much or you paid too little to the LO, then it would be an illegal change. On the other hand, if it turns out that market conditions change or really look at it as cost of talent, you know, if the cost of talent evolves, you can make changes. Or if the market conditions get harsher or better, then you can change just because that's the way the market is. So for those reasons, it's fine. And you could, theoretically, you could change every day. I wouldn't want to, but you could change theoretically every day. Alternatively, you may not change for 10 years. The rule is just no terms or proxies payments, if that makes sense. Figuring out the details is hard. Yes?
You mentioned earlier that the reason obviously we cannot make more money on term or on a specific loan is so we don't scale the client into FHA or conventional loan. However, for borrower pay, we're not making more money
right.
by giving them the option, but actually we're making less money. We're just trying to save them all.
Yeah. So the question about borrower paid is complicated because in the borrower paid scenario, really we're talking about brokers, and so the borrower wouldn't be paying a loan originator in most cases that I would think of. So it's mainly the borrower paid concept is in the broker concept, if that makes sense. And then in addition, I understand that, let's say for example, even taking it out of the borrower paid versus consumer paid to a LO employee of a company, taking it out of that context for a second, and just thinking about if you had a lower rate to the consumer versus a higher rate to the consumer, certainly the borrower would benefit from that lower rate, right? So I think what your scenario is, the guy comes to me and says, I don't want to pay origination fees that high. I want to pay less, or I don't want to pay an interest rate that high. I want to pay less. And you would say, okay, well, I will figure out a way to change the interest rate, get a better rate for you. I'll figure out a way so that we can eliminate origination charges to you, and that way you're benefited. Well, you've just helped out that one borrower, right? But that means that all those other borrowers you didn't do that for, those are violations, if that makes sense. So you have the ability to steer that one borrower to a better product, but you also have the ability to steer all those other people to better products and better charges, so to speak. And so that's where the wrinkle comes in.
My understanding of all that would see exactly how much the borrower is paying you. Then when it just becomes you and him discussing how much he's willing to pay for you to originate the loan.
Right.
To me, I mean, like, that's not any different from a broker, like we charge 1% at one point and then the next person half.
Right.
I mean, like, true, if we go by that same concept, that means that he's steering everybody else and he's violating everybody else that he's charging them 1.5.
Yeah.
Because he gave us 1% at one point.
Right.
So the fact that we're getting paid just from the borrower and we're not getting paid from the company, isn't that the case where we can put the CFPB, hey, this is something that we agreed between us and the borrower.
Right.
The company didn't have to pay the okay, the borrower doesn't have to pay directly.
Right. No, and from a policy standpoint, I think you have a good point. And that is, it does make sense from the borrower's perspective. The rule is just different. And so the rule prohibits the company from paying you differently based on what the borrower is paying. And when you think about the concept where the company is, where you're an employee of the company, you're really getting paid by the company, right? And so unless you set up some arrangement where the borrower pays you directly, you're getting paid by the company. And so that's the complication there. But in addition, all those brokers that you're talking about that pay, they get paid differently by the borrower, 1%, 1.5%, they are in fact violation. And so frequently they don't care and they don't understand that because they don't have the resources. But they are in fact violating the rule if they're getting paid differently, even on borrower paid, based on a term or a condition, if that makes sense. So, and I'm sure there's cheating out there, but that is sort of the way that the way that it works.
So we consider paid by the company if it's borrower paid, if the borrower is paying on the CD, is it considered paid by the company?
Yes. Yeah. I mean, it comes on your W-2, right? Yeah. So that's the complication in this in a scenario like that. But those those brokers, it's a violation. I mean, if they're getting paid differently either by the lender or by the consumer, they can't get paid both, right? But whichever pays them, if they're paying differently based on terms or proxies, then it's a violation for them too. There was a question right back there.
Yes, we're talking about Reg Z loans. Is there any concern to apply the LO comparable to non-Reg Z?
So the reverse loans. So reverse loans are covered by, so the different parts of Reg Z, right? And so the reverse loans are covered by the LO comp rules, but reverse doesn't cover certain types of loans like, I'm sorry, Reg Z and the LO comp rule doesn't cover certain types of loans under Reg Z in certain cases. So there are pieces of Reg Z that don't apply to reverse, as an example. I see what you're saying. So the open-end credit on the reverse side. I see what you're saying. Yeah. So currently it doesn't apply to those loans, but because it's closed-end credit. But you can imagine certainly that that they're thinking about that. And I think the biggest issue for the reverse mortgage world. The biggest issue related to the reverse mortgage world at the CFPB currently is, like much of the industry, they have no idea what that means. They don't know what a reverse mortgage is. And so, right? So in LO Comp, they said, yeah, it applies. LO Comp, it applies. And then in TRID, they said, doesn't apply. Why? Because they don't understand it. And people raise, actually our firm represents NRMLA, the National Reverse Mortgage Loan Association and Lenders Association. And so we make arguments all the time as to how to get reverse mortgage originators and companies out of various regulations at the state and federal level. And so when we told them about how the reverse world worked and how the LO comp rules didn't fit, they had already put it into the proposed reg, and they weren't going to back down. But the second time around, when it came to TRID, they said, okay, we get it. We don't know what we're doing. So they just left it out. Now, they left it out with the caveat that we may come back and change it and put every reverse mortgage into a TRID format, but at the moment they don't. And I think frankly, that's why. Yes?
Is a credit score a term?
So credit score it's funny. It seems like it might not be a term, but it is. So they've said that it is. But the definition of a term of a loan is a right or an obligation of the party. So it's a right that the company has, or an obligation the company has, or a right that the consumer has, or the obligation the consumer has. So theoretically, you could argue that the credit score wouldn't be a term, but when you think back about why the rules were put in place in the first place, in part it's because of the subprime issues that came up, and a lot of those were FICO related or credit score related. And so they just state it. They just say credit score is a term. So you can't pay different based on credit scores. It would create other problems too, potentially, like fair lending issues and so on. But they just, without any sort of substance in the rule, they just say that's what it is. Same with LTV. LTV is also, in my view, not a term exactly, but they call it a term. Because it's not really an obligation of the borrower, and it's not really a right of the borrower, but they say, and I can see arguments on both sides actually, but they just say that it is.
Is there any discussion for like organization of your sponsor to that can lobby for rights and create lawsuits against regulators? A lot of this really seems like you're wrong. It's like
Yeah, no, that's right. And so I would say that the National MBA, the Mortgage Bankers Association, as well as the Texas MBA, both do that. There are other groups as well, but I think at least for independent mortgage companies, those are the entities that have the most members, with the most dedicated members, the best resources, the best contacts with the CFPB and congressmen and so on. It's, I mean, those groups are, I don't know if you're members of either of those groups currently, but they're both great groups. You can get a lot of benefit from joining them, but in addition, they lobby for the industry, especially independent mortgage companies. Yes?
Just the same thing that Randy was mentioning. For the credit, would you see any problem with us structuring our compensation? For example, quite honestly, most of the problems that we have where we lose a lot is with people with excellent credit.
Yeah.
Because they're going to go out there and we're going to go to the bank and see
Right.
they can offer them 0.5% or 8% better.
Right.
So can we structure our commission rule and say, hey, everybody that's making less than this credit score like 660,
Right.
I want to make this. However, anybody that his credit score is over 660, this is what we want, 680 or 700. That's one of the questions that somebody wrote on yesterday.
Right.
And I don't know.
Yeah, so it's the same thing. So they've thought of, the CFPB has thought of that issue, and you really can't. The problem is it's an area where they're trying to protect consumers with a very broad brush. They didn't create a rule, and perhaps fortunately, they didn't create a rule where you can individualize the way that you pay. Now the company can make a concession. So the company could say, we're gonna meet that that offer down the street or at the bank or wherever they have this competing offer. That's fine. So the company can take a hit on that. The company just can't ding the loan officer for, or take money out of the loan officer's pocket for those types of situations. The only way that you can be paid in that sense is across the board, the same amount for all the loans. There's some exceptions, but as a general matter. When you say branch level, it kind of depends what you mean. So it's got to be company money, or if there were a non-producing manager, perhaps there would be something that might be doable. Right. Yes.
Okay, so you stated that
Yeah, products with, yeah.
Because of potential opportunity steering.
Yes.
Okay. What about when you get into something that you could not steer them into, such as a construction loan, a rehab loan product, something like that, which actually takes about 2 to 3 times the amount of time and resources
Right.
to originate a loan that no one would ever take.
Right.
Why couldn't we get paid differently?
So on the construction loans, so the question will come up as to a proxy. I guess the first question is there is a construction loan versus a non-construction loan? Is that a bag of terms like the CFPB says for FHA conventional, as an example? We would say it's not, perhaps, but it really matters what the CFPB says, right? So that's the first question, is whether it's a bag of terms. So they could say that it's a bag of terms. It's unclear. So that's the first issue, though. The second issue is whether you can steer or not, right? And that's in the proxy definition. Does the interest rate, as an example, vary? It does, probably, right? Construction loans are different rates than some others. And so can you steer? Does the loan officer have the ability to steer? And you might argue, no, not really. But on the other hand, it depends who you talk to and what the situation is, but if the loan officer has any ability to influence, and don't actually have to steer, you just have to have the ability to steer. If you have an ability to steer the person from the construction loan into maybe a rehab loan, something like that, then it would be a violation. Again, you don't have to actually do the steering, it just has to, in your policy, you have to have the ability to steer, and it's a violation. And so, well, just because under the old rules, theoretically you could, and then they took it out. They said it's too hard for us, the CFPB, to figure out whether you're gaming the system. And so they took that piece out. Now, there's some theory that you could, and that, that the basis would be, I have to do a lot more work versus a lot less work. And you're just, you're asking to be second guessed, I think, sort of as a risk management kind of a concept. Do you want to take the risk that the CFPB would either say it's a bag of terms, therefore prohibited, or that they would say, well, you could always talk that guy into staying in his own house and getting a rehab loan, or getting, a loan that is not construction or perm or different types. Yes.
Okay. So I'm going to be penalized for helping the consumer?
So the first thing to get over with the CFPB is they don't care. They have So the answer is yes. You can be penalized even if you help the consumer. Sort of like the example a moment ago where they have this rule that says that I can't put some borrowers into these, I can't waive origination charges and help out a borrower taking it out of my own pocket. That would be great for that borrower. The CFPB would say, though, well, that just means because you're jerking around all those other guys that you didn't do that for. That's right. That's right. And again, it's just that's the way they look at it. Now, again, as a risk management kind of a concept, you could make a choice like that and take those positions. But the problem is, think back to your own personal liability. Forget about the company's liability for a moment even. Your own personal liability is, if you made 100 grand last year, you're going to pay 300 in penalties if it turns out that CFPB second guesses you on that. So it's a choice that is you got to make with some gravity if you want to take that sort of a position. So I personally, with my money, I wouldn't do it. It sounds way too risky for that kind of a thing. Now, one question that does come up sometimes on the construction context, though, is that what if I have, I have a two-time close loan versus a one-time close loan? How do you work through those? And there are some ways to. It's not that you're paying differently exactly, and the argument is that you're not paying differently, but you could take some. Again, it's risk management, but you could take some choices as to how you pay, even though it's the same amount as all the other loans, but how you pay for one-time close versus two-time close, et cetera, where it does involve more work potentially, but there are some different ways that you could do that. And we can chat. I don't know if that interests everybody or not. We could chat if you want afterwards about some of those. Okay. If we're okay here, I'm going to move on to RESPA Section 8 because we're running a little behind. Again, though, I'm happy to talk about whatever you guys want to. So I'd move to Section 8 if it's good. Yeah? Okay, so Section 8 also is one of those areas that really hasn't changed, but the law itself hasn't changed. And I'm talking Section 8A of RESPA only at the moment, just the referral fee section. And the law hasn't changed, but the way the CFPB interprets it and the aggressiveness with which it enforces the anti-referral fee restrictions has changed pretty dramatically. So the rule is still the same as it was. It's on the statute from way back in 1974. It says that no person can pay any other person anything of value is what they call it. They can't pay any person anything. Again, it could be a pixie stick, in exchange for the referral of business. That's boiled down, that's it. It's a little more complicated, but boiled down, that's it. And then historically, there was this exception that said, for example, if you pay fair market value for services you're actually getting, facilities you're actually getting use of, then that was fine. But the CFPB has taken some actions that have thrown some of that into jeopardy, and we don't quite know where it is going to come out. Most significantly, there is a case currently pending in the DC Circuit Court, and this is where the MBA helps out, actually. So the case is PHH, the large lender, but the MBA, the Mortgage Bankers Association, has spent considerable resources in submitting briefs on behalf of the industry to support PHH's arguments in that case. The oral arguments are actually next week. I'm flying up to sit in on those, and that decision will probably come out sometime in the summer. But that decision will hopefully overturn the CFPB's case last year, where the CFPB said you can't pay anything to anyone who refers you business, even if you're not paying for the referral. So think of this as an example. You have this marketing services agreement, and that's where they first started down this path. You have this marketing services agreement where you're paying somebody to advertise for you. And advertising's fine. You put up an advertisement in the Austin Statesman, you pay however much that costs, and that is fine. The CFPB would tell you, if you get a referral from the Austin Statesman, not just the advertisement, you get a referral in addition, arguably you can't pay for the Austin Statesman to run your ad. Pretty stupid way of interpreting the law. And it directly conflicts with the way the law is written, because the law says you can pay fair market value for services received or for facilities received. But they saw the MSAs, the marketing services agreements, out there, and they were trying to figure out a way to attack those. And so this is what they came up with. They said, well, when they say you can pay for services rendered, it means services rendered where there's no referral. And so if you're paying a realtor to run your advertisements, and you're also getting referrals from the realtor, then arguably the CFPB director would say you can't make those payments, even if you're actually getting the services. Thinking about that, how that argument flows out though, you see the absurdity of the position the CFPB is taking. What if you rent space? So if you go rent space in a realtor's office, and the realtor pays his landlord $20 a square foot, and you say, okay, that space is worth $20 a square foot. I'm gonna pay $20 a square foot for my 200 square feet or whatever I have in my little office that I close up and I lock and keep it all my information safe. If that realtor also refers you business, arguably, under this sort of absurd reading, you couldn't pay the rent. Couldn't even pay $1, even though it was $20 a square foot. So that issue is currently in question, and it, again, I think originates from the marketing services agreements hostility towards those agreements that CFPB had. So they're just being creative, trying to figure out a way to tamp those down. They issued some guidance on MSAs, and they also have issued a couple of settlement agreements in MSAs. And in one of the settlement agreements, Lighthouse is the name, there was an interesting comment. It's just a settlement agreement. It's not the law. It's just a settlement agreement. But the CFPB made an interesting comment. They said, even if you did everything right in that marketing services agreement, even if Lighthouse did all the right things, it paid only the fair market value, it actually got all the services, and the services were legitimate services, even if all that was right, just by Lighthouse entering into that agreement, Lighthouse was saying, hey, I'll do a business deal with you if you send me future business. Otherwise, there wouldn't have been ever an agreement. And that itself, entering into the agreement, was the thing of value given in exchange for those future referrals. It's a pretty novel way and a pretty aggressive way of interpreting the law. And hopefully that will be shot down by the DC Circuit Court, which is, it's a good court. It's a good place for that case to be. But until we get something out of that court, we won't really know. In addition, I would guess that the CFPB, regardless of what the DC Circuit Court says, will still try to find ways to go after these types of situations. So especially the MSAs, even desk rentals to some degree, but I think those are safer. There's much easier to objectively say what something is worth. They're all up in the air at the moment. And so again, on that sort of risk management array, you sort of got to be careful in going into those situations. Again, if for my money today, I wouldn't be doing MSAs. I just wouldn't. But that's why you guys make more than I do. But MSAs, I think, are fraught with risk. Desk rentals, I think, easier to justify, easier to do, easier to make sense out of. But it is an area that is up in the air at the moment. You want to talk about RESPA Section 8? Any questions in that area? Yes. Yeah. Right. Yeah. It's the power of lobbying. So talk about preferred lenders in two categories. So on the one hand, you have these affiliates, right? You have the Pulte's of the world, the DHIs of the world, the D.R. Hortons of the world. So they have their own affiliated lender that they own, right? And so there's a special exception written into the statute that allows affiliated business arrangements. What they have to do to have that situation is they have to give, when the home builder refers the customer to the affiliate, they have to hand them a piece of paper that says, this person's related to me. You can use whoever you want. There may be other people out there better and cheaper and faster. But know that if you use our guys, we at the corporate level, the holding company level, will get a benefit. So you're on notice. So that arrangement is protected in the statute and also in the regs, because the regs come out of the statute, right? And so I think that out of the possibilities for arrangements, that's a pretty safe one. Far safer than an MSA because it's protected by statute. I think the CFPB may still try to figure out ways to attack those. And if you give a discount, if the builder gives a discount to the customer, same as if you gave a discount to the customer, you can refer and the customer can go use whoever they want. But as long as the affiliated lender, so DHI, as long as DHI is not paying D.R. Horton for that referral, it's probably fine. They can pay so D.R. Horton is probably paying, I don't know the details, probably paying the customer, the closing costs or whatever, right? And so those are pretty protected. On the preferred lender side, where it's not an affiliate, I think those are suspect. The CFPB is specifically going after those types of arrangements, especially if they're exclusive. And they're saying, look, when you say it's my preferred lender, that's a referral. And so they're looking for ways in which those preferred lenders are somehow giving something in value in exchange for those preferred lender arrangements. And trying to find ways to attack those. Yeah. Yeah. Right, and so currently they're not, there's nothing proposed currently, but I know they're considering it because, I mean, even HUD, back when HUD had control of RESPA, HUD issued a regulation that would have limited the ability of, the definition of required use is what they changed to try to eliminate those situations, and that got shot down just because HUD didn't follow the proper procedures. CFPB hasn't proposed anything like that, but I would imagine that it's, you know, they're thinking about it. There are a lot of people that are, you know, in your community, for example, that don't like those situations because the capture rate is so high on the builder side. Steering is illegal for a loan originator. For a, depends what you mean, but for a builder, which is not covered by the LO Comp rule, it's not prohibited currently.
Once you have this option, then it's okay. So they can tell them, hey, we're going to give you the best rate of the market, we'll give you 10,000 for the moving costs, but you can go anywhere else. Obviously, we're going to go to there.
Yeah, for the 5,000. Yeah, yeah, that's right. I mean, it is a big problem, and again, I think they're thinking of that. But the LO Comp rule, which is designed in part to address steering, just covers loan originators. So it really is the loan officers, it's the brokers. In certain cases, it's the lenders, but mostly it's the loan officers and brokers that rule covers. So the producers. So, but that's not an affiliated relationship typically. So in rare cases, there are some cases, I guess, like I think there are some realtors that have an affiliated lender. That's true. That's true. Say again. I'm sorry, I just didn't hear the question. Well, so an ABA is an actual company, right? So when DR Horton, as it was the example earlier, when it has DHI, I mean that's an actual full-fledged licensed independent company that, you know, it's in same business you are really, and so that's what the ABA is, and so it's a complicated arrangement, and there's a lot of money that you pour into it, you know, to get the FHA approval. It's $1 million at least. Fannie Freddie are $2.5 million net worth. So I mean, it's a real investment, legitimate company. That's why it's protected. Yes. Okay. A couple minutes to wrap up. Any questions? Yeah.
So you know, obviously you've been at this for a long time, and you sound like you have a very wide, broad vision of all this. And where do you see all of this wrapping up and landing in the next few years?
So I'll give two answers to that. One is that the CFPB has this case next week in DC, and the main issue is in the PHH matter, did the CFPB interpret the rules correctly? One of the issues though, and the DC Circuit just issued an order last week and told the CFPB to address this, be ready to address this, is that we've made, in that case, we've questioned the CFPB's constitutionality. And so some people might say, well, the CFPB could go away. I don't think that's going to happen, frankly. I don't think the DC Circuit would do it. If it did, I don't think the Supreme Court would allow it to stand. And in fact, the NBA would probably support the CFPB's continued existence. But nobody quite knows at the moment. So that's a guess, an educated guess, I hope, but a guess. Where I really think it's going to go is that we're going to have these rules are going to be in place, and the people that are cheating on these rules, so your competitors who are not complying, those people will disappear, because even your individuals like yourselves, you get your $600,000 whatever individual penalty, that may be the end for you, and they can put people out of business, and they can you know, they can take action on your license. There are a lot of things that they can do to make your life miserable and to try to make you go out of business, and they're not hesitant to do that. So I think that's where it's going to, that's where we're headed, is just to a more compliance focused industry where people do things with good companies like yours, where they're focused on it and doing things right, and everybody, in the weeds, those people will sort of fall off and go do something else. They'll find another line of business. One last question, and then we'll wrap up. DOL, the Department of Labor, is that what you mean? Yeah, I'm not sure that one. I do a lot of DOL work, but I'm not certain of that particular case. It might be a question of whether they are employees or not employees. It gets kind of complicated though, in terms of, but I'm trying to figure out how the DOL would be interested in, you know, they care about employment issues primarily. So I assume that, but I don't know the case actually. Yeah, so reverse is covered by RESPA. So if there's a mortgage loan that you have a referral fee involved with, it's going to be a RESPA violation. And we're speaking at a very high level, right? Because there could be a lot of details that I just don't know about in that arrangement. But referral fees would cover the reverse world as well. So I'm going to close. I'll be at the back. I can hang out if you guys want to chat about whatever you want to chat about. But I would just say that my last comment, I think, really is where this industry is going. And so the way to keep yourselves making a lot of money, because there is a lot of money to be made in this industry, and the way to keep yourselves happy in a way, you know, being able to do business the way you want to, is to focus on the big rich areas of business, the places that are not around the fringes of, you know, aggressive interpretation, because those aggressive interpretations can easily be second guessed by these regulators who don't really have any check on them, at least at the moment, and they can penalize you pretty substantially. And so I would focus on the fat areas and try to live off that land itself, and that will keep you right in the heart of what is compliant, what is permissible. And when these other guys sort of fall by the wayside or are left with, you know, years and years of payments in penalties, you'll still be able to scoop up that business that they left aside just because they've been regulated out of the business. So that's the law. I'm Troy Garris.